Welcome back to Intermediate Accounting, and this series of videos is going to cover the following topics: calculating depreciation expense using 4 separate methods, calculating depreciation expense for partial years, revisions of depreciation estimates, impairment, and finally depletion. Depreciation is a method of allocating an asset's cost, or more specifically, an asset's depreciable cost minus salvage value, over its estimated useful life. There's different ways that these costs can be allocated across the estimated useful lives, as we can see here: the activity method, straight line method, sum of years digits, and double declining balance. Now, there's also 2 other methods allowed by GAAP, group or composite methods and hybrid or combination methods, but those are used very infrequently, so we're going to cover simply those first 4 methods. In determining depreciation, we need to know the answer to several questions: what depreciable base is to be used, what is the asset's useful life, and which of these following 4 methods is the best method of allocating the cost of the asset over its useful life. Let's get started by looking at the straight line method. This is the method that's used most frequently by companies, and it's also the simplest method. So here's our first example. We're going to use these facts to calculate depreciation expense, book value, and accumulated depreciation over each year of the asset's 5-year life, using each one of these methods of depreciation: straight line first, then activity, sum of years digits, and finally double declining balance method. Keisha's Coal Mines is looking into purchasing a crane. The crane costs $500,000. At the end of its 5-year estimated useful life, the company expects to sell it for $50,000. And this crane is also expected to have to be used for a total of 30,000 hours. So let's calculate depreciation expense, accumulated depreciation, and ending book value for each year of the asset's 5-year life. Let's take down some notes. So when we're going into the straight line method, here is our first example. And the straight line method, this is the most logical method, where we simply take the depreciable base or the asset's cost minus its salvage value. Salvage value is also sometimes referred to as a residual value. And again, the term cost minus salvage value is often referred to as a depreciable base or a depreciation base. This is the net cost to the company of the asset. Let's allocate that net cost over the asset's estimated useful life. And again, what we're getting here with this depreciation method is the depreciation expense per year. Okay, so depreciation expense per year in this example, the crane has a cost of $500,000. The net cost or depreciable base is the difference between the $500,000 cost and the $50,000 the company expects to receive at the end of its useful life when it sells the asset. So $450,000 allocated across the 5-year estimated life of this crane. So this is equal to $450,000 over 5 years, or depreciation expense per year is $90,000. And in straight line method, of course, that's always going to hold. It's going to be consistent because we're taking the average, the amount per year. So when we set up our table for depreciation expense in each year, now we can just write for depreciation expense, we know that it's going to be $90,000 per year. And so let's say in year 1, 2, 3, 4, and 5, while the depreciation expense remains the same, $90,000 every year, what does change is accumulated depreciation, because remember, accumulated depreciation is the total of all of the depreciation expense recorded on the asset in its life. So accumulated depreciation, we also want to keep in mind not only what is depreciation expense per year, but what is accumulated depreciation in any given year. And another way of saying that is, what is the total amount of depreciation expense that's ever been recorded on the asset. So at the end of year 1, it's the 190,000. At the end of year 2, we take the 90,000 and we add the additional 90,000 to get 180,000. And that continues on. Add the additional 90,000 to get 270,000. 270,000 plus an additional 90,000, 360,000. And add that additional 90,000 and we get 450,000. So why do we need this accumulated depreciation? Well, it's going to be reported that depreciation expense is of course reported on the income statement. Remember, in the operating section. Selling, general, and administrative, depending on selling if it relates to the stores and selling activities of the company. General administrative if it relates more to the corporate operations. Accumulated depreciation, we're going to see this on the balance sheet. We're going to see every year, we're going to see the crane, the cost of the crane, 500,000, less the accumulated depreciation at the end of that year. And cost minus accumulated depreciation gives us a term called book value, or sometimes we call this net book value. The book value of the asset. Book value, and this is really important, is equal to the cost of the asset, which of course does not change over time, less the accumulated depreciation on that asset, which will change over time. So cost minus accumulated depreciation equals book value. We've done calculations like this other times during the semester. Remember, we also had accounts receivable less the allowance for doubtful accounts was called the net realizable value. Here we call this the net book value, or sometimes just book value. So the cost always remains 500,000. And if we take that cost of 500,000 and subtract the 90,000 at the end of year 1, we say the asset, the crane, has a book value of 410,000, and that gets reported on the balance sheet. So the asset at its cost minus the accumulated depreciation is also shown on the balance sheet. So the book value at the end of year 1 is 410,000. We can either reduce that an additional 90,000 for one more depreciation expense, or we can say the asset's initial cost 500,000 less the accumulated depreciation at the end of year 2 of 180,000. Is equal to our book value at the end of year 2 of 320,000. And then we continue this. We can either say the 320,000 minus the 90,000, the next depreciation expense that is recorded in year 3, or we can look at this as the cost 500,000 less the accumulated depreciation at the end of year 3. And then if we continue this on for the next few years, again, 500,000 minus 360,000 gives us a net book value at the end of year 4 of 140,000. And in that last year, our net book value should be equal to what? What should we find here even before we do any math? Well, we are writing down or depreciating our asset until it reaches that 50,000 residual value or salvage value. And so if we take the 140 and subtract out that last depreciation expense, or take our 500,000 and subtract out the accumulated depreciation of 450, we indeed get a net book value of 50,000. This is exactly what we want it to be because we want it to equal salvage value. And so our last year's ending book value must equal our expected salvage value or estimated salvage value. We forced it to by subtracting out the 50,000 here in our formula where we calculated the depreciation expense per year of 90,000. Okay, so what did we do? We solved for depreciation expense, accumulated depreciation, and book value in each year of the 5-year of the asset's life. Now let's take a look at another method. Same facts about the crane, but now let's assume that the company uses the activity method. The activity method is similar to straight line, but it differs because it says rather than time being what causes the machine or the asset to wear out, it's usage. And so what the company does is it estimates how many activity units is this asset expected to be used for or produce over its lifetime. So for a car, you might say, I expect a car to be used, let's say 12 years or perhaps 200,000 miles. And so the 12 years would be straight line method, where we're coming up with a depreciation expense per year. And the activity method would be, I expect to use this car for about 200,000 miles. That would give us a rate. Every mile that I drive, this is how much depreciation expense I expect to incur. So to calculate the total depreciation expense for the period, we would need to say how many miles were actually driven or how many units were used up in that period. So the company is expecting to use their crane for 30,000 hours over its life, and here's the actual usage. So let's copy this chart and work through our problem that continues with our activity method. This is method 2. So we need to know exactly how much this asset is going to be used. And here is our actual activity. Okay, so for the activity method, depreciation expense for a period is going to be equal to, it's going to look like the formula for straight line. Take the asset's cost, subtract out the salvage value, but now instead of dividing by the number of years in the estimated useful life, we're going to divide by the estimated total units, and that unit may be miles, hours used, number of donuts produced over the oven's life, whatever that company decides, expected over the asset's useful life. And so if you have a car that has a depreciable base of $20,000 and you're expecting to use it for 200,000 miles, that doesn't give you depreciation expense, that gives you depreciation rate. And to get the expense, we need to take that depreciation rate and multiply it by the actual activity for the period. So we need to take the depreciation rate and multiply it by the actual number of units. And remember, when we say units, that could be hours, miles, number of goods that were produced, used, or produced during the period. And that will give you your depreciation expense for the period. So with our information that we have here, we have a crane that cost $500,000, subtract out the salvage value, of course, to get a depreciable base of $450,000. And this time we're saying this is going to be allocated across a useful life in terms of units, 30,000 hours, rather than 5 years, 30,000 hours. So when we divide $450,000 divide by 30,000 hours, we get a depreciation rate of $15 per hour. This is our rate. And what does this represent? Every time we use the crane, we say that we're using, for 1 hour, we're using up about $15 worth of the value of that crane. So we need to take this $15 an hour depreciation rate and apply it towards how much was actually used. How many hours was that crane run in business? So take this depreciation rate, we're going to make a table similar to the one that we did above, where we have years 1, 2, 3, 4, and 5. And then multiply that rate, which is $15 in every year, by the number of hours used. And that has to be given to us. There's no way for us to know that. So we have 6,000, 8,000, 7,000, 5,000, and 4,000. So we have our dollar amount per hour, we multiply it by the number of hours used, and this will give us the amount of our depreciation expense. 90,000 in year 1, 120,000 in year 2, 105,000 in year 3, 75,000 in year 4, and 60,000 in year 5. We can just kind of do a quick reasonableness test by checking to make sure that the more hours the asset is used, the higher the depreciation expense. And that